What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be discussing two dollar stores, Dollar General and Dollar Tree, as they just reported Q2 earnings results on Thursday. These two companies are direct competitors and battled for market share constantly. They've also seen a crazy amount of appreciation since they both went public back in 2009. As these companies are considered consumer staples, they're more defensive in nature and won't see as much volatility as that much of other sectors such as tech. As we continue to move forward into 2020, I wanted to take a deep dive into these companies' financials, ultimately decide which one is a better investment between the two, and assign them a value of buy, hold, or sell. Before we get started, I'd just like to let you guys know that about 90% of you guys that actually watch this content aren't subscribed to the channel. I just wanted to say, if you do enjoy this content, please consider subscribing, as it really does help me out and encourages me to continue publicly releasing all the research that I do on the stock market. Let's go ahead and get into the video. Now, just taking a look at the primary macroeconomic factors that affect these companies. It said, even in Dollar General's 10Q statement, that the main macroeconomic factors that affect these companies are the unemployment rate, wage growth, change in U.S. and global trade policy, including price increases from tariffs, and changes to certain government assistance programs. So that is all the stimulus that we've been talking about in the past few months. So the first thing we're looking at here is the unemployment rate, and as you can see, it's pretty cyclical, and it reached pretty much its all-time high when the COVID-19 pandemic surfaced and hit most of North America, getting almost as high as 15 to 16%. It is on the downturn now. You can see here that it has started and trended downward towards 10%, and hopefully that continues to increase as the economy recovers and we potentially get rid of this virus in North America and avoid a second wave. The second graph I'm showing you guys here is wage growth, basically back to the 1960s in the US. And for the most part, it has been positive, except during periods of extreme recessions or major stock market crashes, like in 2000, 2001. You can see it just dipped below 0% and actually went negative during the 2007, 2008, 2009 financial bubble. And you can see now it's as low as it's ever been, or dipped as low as it's ever been, below 5% wage growth during the COVID-19 pandemic. As these companies are heavily reliant on disposable income being spent at their stores, negative wage growth and high unemployment is very unfavorable business conditions for them to operate in. So consumer confidence, this one's pretty self-explanatory here. What I have up on the screen is the average of the OECD countries worldwide. So the consumer confidence indicator provides an indication of future developments of households, consumption, and savings. And this is a survey index based upon answers regarding their expected financial situation, their sentiment on the general economic situation, unemployment, and capability of savings. An indicator above 100 signals a boost in the consumer confidence towards the future economic situation, and anything below that is seen as more pessimistic. You can see here that I have the past 20 years up on the screen, and it is definitely in one of its lower points. Some of the countries all the way down there at 95%, but obviously anything above 100 is more favorable, and currently we're sitting just below 100, so not very favorable survey data here on consumer confidence. The next graph I have is the business confidence, and the business confidence indicator provides information on future developments based on opinion surveys on developments in production, orders, and stocks of finished goods in the industry sector. It can be used to monitor output growth and to anticipate turning points in the economic activity, as again, anything above 100 is good, anything below 100 is bad. And you can see here, we've only slipped below 100 a few times, and we are currently below 100 in terms of the average of the OECD countries worldwide. So again, another unfavorable indicator here, basically indicating that most of the world is in a recession right now and recovering from a worldwide health pandemic. So now getting into the two actual companies we're talking about today, we have Dollar General as well as Dollar Tree. I'm going to show you some of the basic technical indicators for Dollar General here. So currently trading at about $201 at the time of this video, has a beta below 1, which indicates that it is less volatile than that of the greater market. It has a market cap of about $50 billion currently, EPS of about 7.71, PE ratio based on the last 12 months is 26.26. The 1-year target estimate average of all the analysts that cover this stock is about $207.8. If we compare and contrast some of those numbers to the Dollar Tree company here, you can see it's a much smaller company sitting at about just under $23 billion. Currently, it's trading at about $96.72 at the time of this recording. It has a slightly higher beta, a slightly higher PE ratio, lower EPS than their major competitor, Dollar General. These are companies that won't be subject to cycles of the market. Moving on now to the recommendation trends as well as analyst price targets. If we compare and contrast both of these companies, we have Dollar General's recommendations on the left and Dollar Tree on the right. We kind of have it split in the middle. Most analysts, I would say, are recommended. Well, it's about half and half. So I would say for both companies, half analysts are recommending a buy, half analysts are recommending a hold. The recommendation rating for Dollar General is 2, which indicates a buy, and the recommendation for Dollar Tree is 2.3, in between a buy and a hold. Similar to the recommendation trends, you can see here that both these companies are right near the average of their price targets. Some of the higher price targets for Dollar General sit about $225, whereas the higher ones for Dollar Tree sit at $125. Both providing significant upside if they ever hit that target, but both these companies are basically sitting near the average price targets given by Wall Street analysts. EPS targets, this isn't necessarily indicative of anything, but good to see that one company is consistently beating EPS estimates from Wall Street analysts, whereas Dollar Tree has been a little bit behind that trend and actually missed EPS twice in 2019, both in Q3 and Q4. Again, EPS targets aren't necessarily indicative of anything. It's just where the companies end up in relation to what Wall Street thinks, basically. Sometimes that ends up being positive, sometimes that ends up being negative. Comparing and contrasting their quarterly financial results here, you can see revenues for Dollar General on the left-hand side here have been pretty stagnant for the past 3 quarters, but had a little bit of a boost in Q2 2020, which is interesting because that was supposed to be the worst quarter in terms of the pandemic, and most companies that I've at least looked at saw an extreme decrease in earnings during Q2. Dollar General actually showing that it helped their business as they stayed open during this time. For Dollar Tree, their revenues kind of up and down, same with their earnings. I would say that Dollar General has been a little bit more consistent in this regard. So just reading some of Dollar General's year-over-year highlights from Q2 2020 compared to that of Q2 2019. The first is that net sales increased 24.4% to $8.68 billion. Sales in same stores increased 18.8%, primarily reflecting a substantial increase in items per transaction. Average sales per square foot for all stores was $260. Gross profit as a percentage of net sales was 32.5% in the 2020 period and 30.8% in the 2019 period. That's an increase of 167 basis points, primarily reflecting higher initial inventory markups, a significant increase in sales of non-consumable products, and favorable markdowns. Selling and general administrative expense as a percentage of net sales was 20.4% in the 2020 period compared to that of 22.5% in the 2019 period. That's a decrease of 205 basis points due in part to lower retail labor, occupancy, and utilities costs as a percentage of net sales. Operating profit increased 80.5% to $1.04 billion in the 2020 period compared to $0.58 billion in the 2019 period. Interest expense increased by $14.5 million in the 2020 period, primarily due to higher average outstanding debt balances in connection with the issuance of debt in the first quarter of 2020. We know that most companies saw that this pandemic was going to affect their operations adversely, so a lot of companies did issue debt, especially a company like Dollar General, Dollar Tree. These are consumer staple companies that definitely rely on revenue in order to pay down their debts consistently every period. Net income was $787.6 million, or $3.12 per diluted share in the 2020 period compared to net income of $426.6 million or 1.65 per diluted share in the 2019 period. This highlights the cash which was generated from operating activities in the 2020 period of about $2.91 billion, an increase of $1.78 billion over the comparable 2019 period. Now, they did mention something about inventory turnover. I'm going to be getting into that a little bit later on in the video. For now, let's go ahead and move on to Dollar Tree's year-over-year highlights. So, consolidated net sales increased 9.4% to $6.28 billion from $5.74 billion in the prior year's second quarter. Enterprise same-store sales increased 7.2%. Same-store sales for Family Dollar increased 11.6%, whereas Dollar Tree same-store sales increased by 3.1%. Put that together and you get 7.2%. Gross profit increased 16.2% to $1.92 billion in the quarter compared to the prior year's second quarter. As a percentage of net sales, gross margin increased 180 basis points to 30.5% compared to 28.7% in the prior year's quarter. The increase in gross margin was primarily driven by improved merchandise costs, including freight, leverage on occupancy costs from stronger same-store sales, reduced markdowns, and improved shrink results, partially offset by higher distribution costs, which included $11.4 million in COVID-19 related payroll costs and incremental tariffs of approximately $10.8 million. Selling, general, and administrative expenses were 24.5% of net sales compared to 24% of net sales in the prior year's second quarter. The increase was primarily driven by COVID-19 costs of $123.5 million, or 197 basis points, related to frontline associate wage premiums, field management bonuses, and store supplies. Operating income for the quarter improved 39.4% to $374.9 million compared with $268.9 million in the same period last year, and operating income margin was 6% in the current quarter compared to 4.7% in last year's quarter. The second quarter of 2020 included total incremental operating costs of $134.9 million for COVID-19 related expenses. Additionally, during the second quarter of 2020, the company experienced store damage, lost inventory, and other costs of $16.8 million related to civil unrest in certain communities, comprised of $11.7 million of Family Dollar and $5.1 million of Dollar Tree. Together, expenses related to COVID and civil unrest for the quarter were $151.7 million, or about 50 cents per diluted share. Net income was $261.5 million in the second quarter, and diluted earnings per share for the quarter increased 44.7% to 1.1 compared to 0.76 per share in the prior year's quarter. A couple final things that I calculated here based on the company's financials were the inventory turnover, the cash reserve, and debt comparisons, as well as the current ratio. The inventory turnover for the last quarter was about the same for both companies, Dollar General sitting at about 1.29 and then Dollar Tree sitting at about 1.28. I think that just indicates that the companies are kind of competing with each other and they have very similar operating results here. Not too much to be concerned with on either side. Both companies are turning over their inventory at a decent rate. If we look at the cash reserve and debt comparison for the past 2 years, you can see here that there's been an increase in long-term debt by Dollar General by a significant amount, whereas Dollar Tree seems to have actually paid down a portion of their long-term debt. But if you actually look at the cash reserves or current cash and equivalents, Dollar General has also beefed up their cash significantly and has more cash to pay down their long-term debt currently than Dollar Tree has. The debt to equity ratios aren't crazy. It's good to see that at least the companies are building up cash in case they need to go a prolonged period without generating revenue and earnings. And the last thing that we're just going to look at quickly is the current ratio comparison and how that has trended in the past 2 years. Dollar General has had the better current ratio for the past 2 years, and Dollar Tree has improved their current ratio in the past year, but not by much. I think this is just indicating in general that Dollar General has more cash to pay down their current liabilities, and again, that's good to see. I think most of these stats are pretty indicative of Dollar General being a better run business or just a bigger run business overall. Okay, now that we've been through the company's financials and we've kind of compared and contrasted both companies, I think it's very clear that there's the better company here. That is Dollar General. If you were to decide to invest in either of these companies or into this industry, I would definitely be choosing Dollar General over Dollar Tree, simply for the fact that they have a higher inventory turnover ratio, they have a better debt to equity comparison, and they also have a better current ratio. Since these companies went public, they've both appreciated tremendous amounts, and it's hard to say whether there's much more value there. As these are consumer staple picks, you typically don't see them continue going up forever. You tend to see them top out and start growing through acquisitions. I think these companies are starting to get to that stage, and I don't know if an investment into either of these companies is viable. I'd just like to let you guys also know that I currently own no shares of these companies, so this review has been completely unbiased. One positive for these companies is that during Q2 2020, when majority of other companies reported much bigger losses than anticipated, much lower revenues and earnings, these companies' businesses actually grew, showing the resilience of their sector. However, moving forward, I'm not sure that I can fully justify these valuations. They are certainly behemoths in the sector and will continue to grow as they have tons of cash via acquisitions and things of that nature. I'm not sure that this increased growth for the health pandemic is justified and will continue moving forward. For that reason, I'm not sure that I can recommend a buy in this case. I'm probably more so on the hold end of things. I don't think you should sell this company if you already hold it. Maybe take profit. I wouldn't sell shares completely, but I would probably assign these companies a hold. And if you were dire and were going to invest in one of these companies, I would be investing in Dollar General instead of Dollar Tree. So that's all I have for you guys today. I hope you guys did enjoy. If you did, don't forget to smash the like button, subscribe to the channel if you enjoy this type of content, and share the video with a friend if you learned something. As usual, have an awesome day. Peace out.
Young age, learn how to get paid. Big stage, long way from session A. Big wave, he gon' have to get saved.